Welcome to our channel Stocks in the USA. Today we will discuss how the market can often be irrational and almost crazy. Recently, one of the giants of the stock market released its quarterly earnings report, which was quite positive. However, the market reacted with a nearly 6% drop in after-hours trading, which seems quite insane. We're talking about Alphabet Inc., Google, GUG. We all know this company, which is constantly growing and is one of the true giants of the world stock market. Its turnover is higher than many small states in the world. It is useless to dwell on the description of Alphabet and all its businesses, so we will get straight to the point of this video. So, let's conduct a brief analysis of the quarterly report to understand what might be amiss or if this reaction is an anomaly. But before we dive into our analysis, please remember to subscribe to our channel. Give us a thumbs up and activate notifications to stay updated on our new videos. Let's get started. After the market closed, Alphabet's latest quarterly earnings were released, and the market's reaction took everyone by surprise. So let's analyze the data to figure out what went wrong. Alphabet, Google, reported revenue of $155 billion, surpassing expectations of $145 billion, and a profit of $76.7 billion compared to the expected $75.8 billion, all very positive signs. Expenses were significantly reduced, dropping from $902 million to $148 million, and net income increased from $13.91 billion to $19.689 billion, again, all positive. So what irritated the market and analysts? Reading some comments, it appears that Google's cloud services didn't perform as well as expected. While the revenue was projected to be $8.6 billion, it only reached $841 billion. Yes, you read that correctly. A marginal deviation in just one aspect of the quarterly report seemed to bother analysts. Google Cloud's revenue increased from $6.868 billion to $841 billion, and it turned from a $440 million loss to a $266 million gain. But it wasn't enough to avoid disappointment. A missed target by just over $200 million in revenue for a company with $155 billion in revenue seems to be viewed as a catastrophe. This is pure speculative madness. Nonetheless, this is the market, and for investors, it's excellent news for those considering investing in a solid company with immeasurable potential. Just to remind those who might not be aware, probably very few, Alphabet owns the two largest search engines in the world, Google Search and YouTube. It's one of the companies that has invested the most in artificial intelligence, and it's still doing so at incredible levels. Google's upcoming projects for the next few years are astonishing and could revolutionize the digital sector like never before. Let's continue with the remarkable data. YouTube ads revenue increased from $7,071 billion to $7,952 billion, and Google search revenue increased from $39.539 billion to $44.26 billion. Very incredible. In short, this reaction is truly beyond any logic. It could be a real opportunity to invest in a stock that, at this price, appears to be a bargain, especially if your potential target price could exceed $210. However, we're talking about a company in the midst of AI-driven development, and this could just be the beginning of a great journey towards much higher prices than those predicted today. In conclusion, we can only say that markets are often irrational or driven by interests that go beyond our knowledge as humble analysts and stock market enthusiasts. Today, we'll see what happens when the market opens. The fact remains that such a significant drop for such a strong and healthy company is hard to explain. Still, we can turn it to our advantage and seize the opportunity presented to us. Finally, please remember that we are not financial advisors, and this is not an invitation to buy. It's simply our analysis based on our experience in the US stock markets. Dive deeper into our analysis, explore other sources, and always make independent and well-considered decisions about where to invest your money. See you soon, investors.